Yeah. Okay. Great.
By the way, you can take questions directly in a presentation if it applies to the slide or through direct. Rather, if not, then hold to the afterwards. We've got lots of time for questions after each presentation.
Okay, thanks for that, Greg. I'm not sure where you got that info from. Some of it was right. It must have been Kim. The splits was when I was a bit younger. I've given up in the recent years because it gets it's a little bit more challenging on the hamstrings these days. So yeah, thanks, Alex, Greg, Cinnabar, opportunity to present you guys. We're going to try and talk a little bit about trying to find alpha. That's not so easy, but let's have a look at that. A little bit about us. So we'll be 10 years old as a business at the end of July this year. We started 6 weeks before the Lehman's crisis, which was not very clever, but managed to survive that. Started in the hedge space, and then with 100 million rand at the time, and then we've grown the business steadily over time, and we went into the long-only space 5.5 years ago. But so the composition of our business now. Gavin and myself started ex-Deutsche. I was there for 12 years. Gavin was probably there about 10 years. Came back from London and joined me. And I guess if we look, we're running assets now of about 21 billion or so. Our hedge assets about 3.5 billion. We do Africa as well, and we're running about 2.5 to 3 billion rand in Africa, non-South Africa. So that's the business. And the split of assets from an international basis, we have about 55% of our assets come from offshore. So that's the business. From a team-wise, we've grown from literally 3 of us in the beginning. We now have 21 individuals in the organization. We've very much fundamental bottom-up is the core of our philosophy. We've got a whole lot of accountants, which is not a good thing these days. I think we've got about 12 CAs in our ops, our businesses, but that's not good. Maybe we're all going to lose our CA charters going forward, but we do have about 11 or 12, 13, 12, 11 CFAs. Okay, that's just the investment team there. In terms of if we have a look, our business. So we're going to focus on the long-only space, not the hedge funds, which we run. I guess starting off really in the unit trust space with the flexible unit trust. That was the first fund that we started running. We 5 and a bit years now. And we thought that is typical to the opportunity to move the nets around. Not that we do it hugely, but at least have the opportunity. So the objective in that fund is to try and over time beat the Aussie, but a lower vol than the Aussie. So that was the objective when we started. And when you start funds, everyone wants to know what's your objective. You think you have a sort of objective, you try and do that, and over time you see what happens. Pretty much so that's what this has done. It's been going for 5 and a bit years. It's done 14% compound. The market's done 10 over that time, so it's done pretty well. In that category, it still is last month #1 over that period. And it actually has beaten every single equity fund over the same period, be it very small, but it is one against any equity fund. We have then started, it's got about 2 billion in that fund. We then started a flexible fund, a long-only equity fund, and pure fully invested, and that's been going now for 4 years or so. It ranks reasonably sort of in the top 10 of 114 funds over that period. And then we started a balance, a Reg 28 fund as well. Quite a few people want to put some of the savings, Reg 28, and that's a very short history, that balance fund. It's been going for 2 and a bit years now, and it also ranks in the top 10 there. So that was, so far they've been good, and the hedge funds have also done fairly well over time. So a little bit just before, sort of the buckets of what we look at, how we try and generate returns. So fundamental bottom-up is what we do. Very much business assessment, financial assessment, and valuation. 3 buckets, which is nothing special. It's how well you do it. That's it. Everyone sort of does it. It's just how well each bucket you do and the attention to detail in every bucket. So that's what we do, and we've got lots of guys, and we do no different, I think, to anyone else out there. Over and above that, and then we have a macro overlay, so we're pretty much 2/3 bottom up, 1/3 top down. And then what we do, I think, differently, because everyone, sorry, I'm struggling. I was on a plane from London this morning, so I'm struggling a bit. Not that bad. What we focus on is, from investment banking background, special situations, event-driven, we play quite a lot of that, whether it be in South Africa or Africa. So that's an area where we are a little bit different. We cover Africa A lot of South African companies also have Africa. We have a lot of the investment team travel. Everyone travels, with the exception of one person. Everyone just travels to different African countries. So we do. Our banks analyst does South Africa, will be in Nigeria, Kenya, Egypt. So we look at it holistically, which does give a bit of an advantage. And then I guess the other area that we do is when you have capital raises, placings of shares, underwritings, that space. And we'll have a little bit of a look at that. And that's what the focus will be. So if we do the core of what we do is the bottom part, and if we get right 60% of the time over time, we're comfortable we'll be in the top decile of any of the managers. So that's what we'd like to be. We get lots of things wrong, but if we can get 60% right over time, we think we'll do pretty well in the long run. Okay, so this is the area. So that we're going to focus on is opportunistic trades, really, because I think that's where picking stocks, you can get good stocks, you get bad stocks, hopefully more good ones than bad stocks relative to an index over time, but special situations come across and they can add quite significantly to your alpha. So if we just look in the last 12, 18 months, some of the players that we've been in, there've been a couple of capital raises. Now, if we look at something like Dis-Chem, for example, Dis-Chem, when they came to the market, they didn't release much stock. It was placed at 18 Rand. It must be about just under a year and a half ago, that they placed the shares, very difficult to get. And that stock now it's up 100% since over 100% since listing. Now, how do we go about? Everyone wants to get Dis-Chem because it was going to be a very attractive share. So you need to play different angles. One, you need to know the bankers who are going to run the deal. So that's fairly important. So you need to know if it's a Citibank, if it's Investec was involved in it. You need to know the heads of the capital markets. You need to early on up front tell them that you're interested in getting the stock. Then you need to try and know the management. That'll also help because when shares get allocated, the bankers get involved and they say, okay, let's assume there's R1 billion to be allocated out to the market, just simply. Then they'll say, okay, well, our key clients, the bankers will say our key clients might be Coronation, Allan Gray. Laurium sort of sits, it's not up there quite yet. And then they'd go down. Who do we want? Which shareholders do we want to have out there? Then they talk to management. Management will say, no, but listen, we know those guys. We want to give them some more shares. So there's a combination in any allocations, how things work. I guess the price you come in, if you put in a price, what you're prepared to pay. So there's a game to play that. And having spent many years being on the other side and doing these things, we have a pretty good idea on how these things work. As it happens, Dis-Chem, we've got extremely big allocations. We've got about R500 million in the placing, what we did. It does help that the COO is sort of a neighbor, COO, in that instance. It helped the process. So it's important. You need to know the management and you need to know the bankers to help you get a decent allocation. And you can also go early up front. If you tell them a couple of months before, listen, we want to be there, we want a big slug of your listing, well in front, they tend to look after you. So if you give them an undertaking beforehand. So we do that as well. Another one, okay, Star was linked to, there was a placing the other day. The listing has been very successful until the Steinhoff debacle happened. We'll have a look at that. But it's from the listing price, it's actually above that. They had a placing the other day where we actually took, I think, 200 million across our funds. That was a week ago. Steinhoff placed about 6-7% of their holdings. There's still more to come in 3 months' time because there's a lockup. And there we took, the number is probably about 150 million or so of shares at a decent price, 18.50. Today it's, I don't know where Stars, it's 20.50. That's just in a few days. So it was down at a 10% discount to where it had been 3 days before. We'll play it, and we'll probably look to get out of it. If we make 10% plus, 10-12% on that, we'll sell it because there's more coming in 3 months, 4 months' time. But it is quite cheap anyway because of this overhang. So that's something we played. I guess rights issues. So rights issues, there's, who knows what a rights issue is? No, I would expect all the hands to go. Okay, when a company comes out and they say we're going to, if they wanted, if you've got 100 shares in the company, you say we're going to raise 10% more capital, and then I'm going to give you, so for every 100 shares, we're going to give you another 10 shares at a discount to enable you to take them up. But sometimes what happens, you get situations where excess right, people don't take their rights up. And a situation was in Nigeria, which we took in. A stock was trading, let's say the share price of Unilever in Nigeria was 44 Rand, and they were offering you rights. You only had to pay 30 Rand to come in. Okay, so if you're a shareholder, you would take them up, but a lot of shareholders in Nigeria didn't take it up. We then go and apply for any excess rights in Nigeria, and what we did there is we put in for about 20 million rands worth for excess rights. 2030, it was about 25 million rand, and we said we'll take excess rights at 30. Now the problem is you had to put that money up for a month in advance. So a lot of people didn't do it. Of what we asked for, we got 53% of our allocation, and we sold that out at over 40 bucks. That's a 50% return on what we did in 5 weeks. Now we've done it in PPC and Zim, where we put money into Zim to do a rights offer, also free rights, probably 40% upside. That's in Africa. We have a little bit of Africa in our Flex and our Balance Fund and in some of our hedge funds at times, and we run a sort of $250 million Africa fund. So in Africa, there's some pretty interesting stuff, and that's exceptional. You don't get stuff like that, but you need to know the markets. You need very strong operations teams as well, which we've got some really talented guys on our ops teams. We've got three accountants in our ops team, and 3 of them also got CFAs. And you need to be in tune. So that's where we play, and that's very different to the norm. And that's where these things, because I'd say in a lot of these situations, I'd say there's probably a 70-80% hit rate on these things when we play. So it offsets a lot of mistakes, other mistakes. So by default, we make less mistakes, a little bit less mistakes. Then the other one, if we look over here, this is sort of secondary placings. Barclays, Exara. Exara was a huge one that we made a lot of money on. The BE scheme was coming to the end after 7 years. This was about 18 months ago. And everyone knew the BE groupings, as soon as they came to the end of the period, they were going to sell their shares because they were in the money for 7 billion rand. So what happens when you can share after 7-year lockup, your 7 billion's coming you? What do you want to do? Who knows? What are you going to do? You're going to buy some toys, cars, a few things. So we knew it was all coming. So this was going to, in our hedge funds, we were short. From a month before, we actually shorted the stock. And we were long Kumba against it because it owns a lot of Kumba, and it owns an offshore, and it owns coal. So in the hedge funds, we actually were short the stock. After this, within 2 weeks of them coming and the lockup finishing, they came and they placed a huge amount. We'd been to see Citibank was running it. The head of banking at Citi had been to have a meeting with them, said, listen, we'll be very keen to take, when you come for this thing, we're assuming it's going to happen to 2 of the bankers who were the advisors. So we knew who the advisors were, whether they were going to do or not, but it was fairly obvious they had to come and do it. They would do it at some stage. And anyway, so we ended up taking 500 million rand of the placing that they ended up doing. We got about 8% of the total book at 87 rand. So once this overhang was out of the way, the thing went up strongly, and probably within 6 months it was already up to 130 something. So that's a special situation that you on top of. So anything BE schemes coming to ends, we're very aware of it and try and play those. So that was one. Barclays, everyone knew there was a placing of Barclays coming. Just didn't know how long. And that stock was very, very cheap. They eventually placed all of that stock. It was, I'm trying to think, they did 45 billion rand of shares they placed at 1 rand, 100, I think it was 132 or 132 rand about a year ago. Share price today, even after dividends, is sitting at about close to 180. It's been from that depressed levels done very well. Still, the valuations still look decent to us. A lot of changes of management there, but we ended up getting, we were the 12th largest asset allocation globally in that thing. We got 900 million rand across all our funds. Very big position. We went in very big. And once it had rallied quite a bit, we chopped a third of our positions. We still owned quite a bit of it. But also, we got in early, spoke to bankers, we went to the company, said, listen, we'd be in for we'd want to be at least 750 million. Must have been 2 months even before they came, because it was depressed. Everyone knew it was coming, so the valuations were cheap. But when it came, then everyone wants it. So that's just sort of showing some of the stuff, other placings there, smaller ones, storage, Equitas, that you come in and you buy in at discounts when they place stock, anywhere between, I guess, 4 to 10% discounts to the share price. So we play a lot in that space, and that's where you can get some very good alpha. I see Mike Patchett here listening closely.
Did the bankers know you were short of Exara at the time that you found?
We didn't tell them. We didn't have to tell them. In our long only funds, we were fine. In our hedge funds, we were short. We had 0 in our long onlys. In our hedge funds, we were actually short. Yeah. But we'd shorted it quite a way before. Yeah. Okay, so now we're going to have just look at a sort of a simple example, which is quite topical, I guess, with what's going on. The biggest bugger up, and the answer is yes, Steinhoff. We've known Steinhoff for a long time. We weren't clever enough not to be in it. We had Steinhoff shares in when it collapsed in December last year. This would happen there. So it was actually at the JP Morgan conference when stock went down 10% day one, 10% day two, something was going on, and Marcus Jooste resigned, and then it fell 40%, and then it's continued to go down. So we had across our funds, from our balance fund of 1% to, I guess, in our equity fund, we were running, we had about 3.3% in the shares. And some commentators thought that in half an hour you could read the accounts and sort of pick up that you could see what was coming. I don't know. You know, a lot of people there, non-execs, that they didn't see it, and it was outright fraud, I guess, and it's quite nasty, some of the stuff that's still coming out. But anyway, so we were reeling in that, taking a lot of pressure over that time. Now, Steinhoff owns, I don't know the structure of Steinhoff. Steinhoff actually owns a lot. In South Africa, it owns, who knows what Steinhoff owns? It owns some listed shares. Who knows what they are? Some of you got to know. PSG, they own 25% of Yanni Mouton's business, PSG. They own 70-something% of Star, which is a great business, which used to, an old Pepcore business, Pepcore and Ackerman, so they own that. They owned Cup, another really good business, Unitrans and that. All very clean businesses, well-run businesses. So they own all of that in South Africa. All the problems have been in Europe, where there's shenanigans and entries, journal entries, I don't know exactly what it'll all come out, but it probably looks like 6 to 12 people are very involved in that. But Aussie was no problem. Asia's no problem. All sat in Europe, what was going on there. Anyway, so PSG, what happened to PSG here? So PSG, they own 25%. Steinhoff collapses. Everyone think all the underlying shares, which is a huge issue here, maybe they're going to need to sell some of their shares. So Steinhoff was trading up here at the price. I can't even see that. It was close to 3,000. Sorry, PSG drops down, and this is when it happens, and bang, this thing comes down in the next few weeks. So what happens? We think then, after we're getting over the shock of Steinhoff, we chopped half of our Steinhoff position straight away. We kept the other half, which is not so clever. But over here, so it's about 4 or 5 days later, we think, well, this thing's down. Maybe PSG is going to go and buy the shares out. So we get hold of, in fact, Gavin in this instance phoned Fit Mouton. We phoned him and said, listen, what's going on with your share here? It's falling out. Look, we'd be quite keen. We said, are you guys going to take some more shares, take some off their hands? We'd be keen to come in, and we said we'll be in for R500 million. We said we're happy to come in at R500 million. That's obviously a decent discount to that price. So to drop to there, we wanted a discount. So anyway, nothing. He said, no, they don't think they're going to take any more, but he'll sort of store that away. Okay, what happens? A week later, Steinhoff have to place some shares. So we get taken over the wall, and What it means is they take a few people, you have to sign a sort of a disclosure that you can't trade the share, non-disclosure agreement. They do it with a couple of people. Because we've said we want $500 million, we get that on a Friday, and then they say they're going to decide what they'll do on the Monday. And we sign a document. In this case, we had to sign a document for the size we wanted, and we had quite a cheeky price. And we said, yeah, we would like to come in at about 225. Share price at 225. It was trading when it was trading 240 is where they actually placed it. So we said 225, and we also wrote in we'll only take it if they place the full amount of shares. So we didn't want an overhang. Said if you place all the shares, we're in. So what happened? Steinhoff only came and placed half the shares. So we actually, I think there were only 2 people who didn't go into book build. So they placed the shares. We didn't. We said our price was much lower. We said we're not in, and we didn't want to raise our price. And then what happened is Cyril got in. So off the share price went, and obviously a few chirps in the office. Oh, well, we should have gone in. We should have gone in. We didn't go in. So it bounces up like that, and then it's so decent. So you made good money if you went in that time. Decent discount to the market. It was placed at the 240. So time moves on, and Steinhoff gets worse and worse, and they need more capital, and I think this seems like it's going to continue. And then we get to a situation end of January. So end of January, the share price is still trading at this levels 260 over here. They come with the second placing, and they're going to clear the whole amount out. So at this stage, even though we said, well, we're prepared to pay higher because we know there's no more overhang, the whole lot's gone. There was a small amount that they were keeping, literally 1.5%. So we're good to play. And that's when we went in. So the first book build was 235. We went in at 240 the second time. So we ended up getting a few $100 million. And that's the price we paid. The share price was up there. So you're getting at a nice discount, which is nice. So you bid in the market. So if you're an index player, we can get in below the index. So the passive guys, that's where we have an edge. When they place at discounts. So we just mustn't have too many other mistakes, and then it's sort of okay. So that's where we got it. And then the stock following that, so that's where it was trading. Once they placed it, off it went. Now it went up a lot stronger than we thought. Charged up. Because people were so happy that it went up here. And we sold out everything. Now, I'm sure Yanni wouldn't be so happy, but we sold every cent in PSG. It went up 16% in a week we made on this trade. It was a lot of money. So we thought, no, everything out. That was the average price we got out, 278, and we bought it at 240. Then we got, now there's luck and skill in life, and we like to, hopefully we can get a bit of both in time. So the luck part happened because we sold out, and then about 5 days later, Capitec, this Viceroy report comes out on Capitec, fish, down it goes. And what happens? PSG goes down. So that was quite lucky, but we were out, every single cent out there, 16%. So that's just sort of a little bit of what goes on in some of these special situations. It's a lot more fun than your basic, okay, let's look at Barclays. Is it cheap? Is it expensive? It's trading at a 9 forward multiple. It's a 1.6 times price to book, dividend yield of 5%, 5.5%, growing its earnings growth, probably sustainable, 5 to 10% range. But you don't need to go and do too much analysis around it. Everyone's looking at all the analysts. There's not much. Is it cheap? Is it expensive? And then we think it's cheap, but this is a little bit more interesting and dynamic. And I think the difference is we're quite small. So we're running 21 billion. Okay, so it's 18 billion in South Africa. We do $500 million. We do $500 million to $1 billion trade is very big on our funds. The big guys, it doesn't move the needle, zero, unless they got a tiny fund. But the big funds, it means zero. But in this place, we think we can make a lot of money. So that's where we find quite a lot of alpha in SA, and in Africa, there's huge potential. Our Africa fund has been going 4 and a bit years. It's beaten the index by 10% compound every year, and about 10% compound per annum, and every year it's been above the index, both indices for Africa and South Africa. So it's done, there's some really nice, juicy things in there, but you need to get your hands dirty. You need to spend a bit of time in Nigeria, which is not fun. Zim is easy to go to. Kenya's not so bad. Egypt, Morocco. we sent our one analyst, Paul. We didn't know much about Morocco. He went for a month. He had to go and live there. Airbnb. He did our research for Africa. 1 month. He had to go and live there. His wife joined him for 2. So at peace for 2 months, 2 weeks. Okay. I'm not saying which 2. Okay, I don't know, outlook and positioning, very briefly, just and then look at where we position. So obviously everyone's on a global basis. I mean, the big issue, I think it's flogged to death, what's going on. QE easing globally, rates rising. It's all about the 10-year yield. Where does it go? Our view is you get to 320 this year. Inflation's still an issue, ticking up. Dollar probably weakens a bit. So it's a race to how sharp the yield curve gets. I think once you get to 3.5%, it's an issue. But the earnings growth is still very strong in the US, 16, 17 multiples. We're in injury time. It's a 10-year expansion. We need to be nervous. But our view is you've still probably got a bit of legs in that market. We probably could retest the highs in the US after this correction. Vol late cycle is high, so you've got to expect it. A lot of money has been made, but we still think there's a little bit more to run on a global basis. Our expected returns beginning of this year in the S&P, we thought a total return of around 6%, which is quite modest. It's actually down. It was probably flat now after bouncing the last few days. So very modest returns, but still look a lot better than bonds on a global basis. And bonds look like they're still going higher, and Europe will follow, I think, in the next 2 years as QE comes away. And the tax benefits, I'm not going to go into all of that. Details. Valuation, MSCI EM looks more attractive than the US, and there's probably still some legs to go in that. Global growth, really good, still at 3.8, growing. SA, everyone's happy from Cyril getting in, so I think it's short term, they're very positive tailwinds in South Africa. I think confidence has obviously turned around significantly, so there's going to be quite a lot of spending. And I think fixed investment spend, this Eskom, this PPPs that have just gone through, IPPs, that's 60,000 jobs, 50 billion spend that they've just announced, 27 contracts on that. That's a start of things happening. And I think businesses, the restocking process we think will surprise on the up for this year. So we think growth this year probably in SAs could be 2.5% to potentially even 3% this year. Strong growth. And then next year, maybe we'll get a similar figure, sort of around 2.5 to 3. So we're quite upbeat on domestics. We've got quite a few domestics in our portfolio, which we did shift, probably about 7% shift into domestics before the election to be neutral rand across the portfolios. We were buying Foschini, Truworths, and we couldn't get enough retailers. We ended up buying Nedbank, which we didn't have, 3% across the funds, which has done quite well, just to get our domestic exposure up, which fortunately worked out okay. But I still think while shares have run quite hard, we've seen a bit of a pullback in these domestics. I think the domestics still look quite decent over the next sort of 18 months or so. We're probably still going to be some decent numbers, decent total returns. Banks comfortably in double-digit returns, total returns, and retailers could surprise in the next 6 to 12 months. If the currency doesn't deteriorate much from here, you'll see their margins widen and probably do quite well. Longer term, there's still big structural things for South Africa that I think is going to be a seriously difficult thing. But where we are now with global growth at sort of the 3.5 to 4s this year and around 3.5 plus next year, we're going to get back to more normalized 3s. So it's quite positive. And we don't have the currency weakening that much this year. We have 12.50. One house there, they've got to go into 10.50. It's quite amazing. But forecasting currency, we have no idea. Yeah, it's just a higher forecast risk with the currency compared to a lot of other things. Okay, so yeah, so we're expecting our view for the market this year, beginning of the year, is a 12% total return. Also, for what it's worth, we have quarterly strat meetings and that, but it's all a guess. It's an educated guess, but it's a guess. But that's what we think. And our market is down now probably 5% for the year. So we think SA still looks reasonably decent for the year from where we sit on equities. And bonds, our view on bonds, sort of 825 is probably for the 10-year bond or 8-year bond. R186 is probably very much sort of fair value. So you don't want to be, I don't think you want to be too long duration from where we are. Maybe there's a little bit more to play, but I think a lot of that game's moved from 925 down to the got below 8 quite recently. Risks, there are always risks out there. Trump, trade wars, lots of that. I don't know what's going to happen there. And then I guess inflation's a big thing in the US. If it surprises a lot on the up, currency weakens a lot more, and then surprise inflation, and the rates go up. And you get long bonds above 350 in the States. That's when you need to be worried. But a lot of the money has been made globally in markets. I think it's far more modest returns going forward. Okay, just in terms of, if we just look at our flexible fund, so the last slide on our positioning, in terms of overall. So we're running our equity components running at 77%, so pretty high equity component. Offshore component is 10%. This fixed income component here. So equities, local, 67.10 offshore. Offshore component here is at 4.8%. It sits in Nigeria T-bills, and it sits in Egypt T-bills. Now, the Nigerian T-bills is also an opportunity. When we put those on, you could hedge forward again into dollars. You're getting 20% return on a basically 11-month T-bill in dollars in Nigeria. And the sovereign dollar bond equivalent was trading at 8. There's a 12% pickup on how you could play it. So that's what we've got, sort of about 3% in there. And then Egypt had a massive deval, and the interest rates went through the roof. And you were also getting about 18%. Inflation's now falling, rates are coming down, and that also when it was put on was 18%. Now you're getting about 13%, and we think the currency strengthens. So that's just an interesting dynamic that we have on that. And then I guess we've got a bit of property. The good news on property, we don't own anything in the resilient stable. We haven't owned anything in the resilient stable for a year and a half. And our hedge funds, we've been on the right side of that. Our hedge funds are up this year anywhere between 4 to 8% for the year, and the market's down 5%. So we've been on the right side of that trade. So we got Steinhoff wrong. We got that one on the right side. Okay, then if we look at just some stocks, what we've got there, I guess Naspers, we still got a decent slug on that. It hasn't performed very well this year. It's about 13% down. It's still 70% up a year. If we look at it, Tencent's very, very highly valued. Anyone got any strong views on Tencent? It's the biggest stock in the index. In the Aussie, it's 19, 18, 19%. In the Swix, which all the pension funds used to follow, it's 20-something percent. In our equity fund, we use a cap Swix, so it's capped at a max of 10. But yeah, Tencent's a great business. Valuations are pretty full on a long-term basis. It's probably 35 forward multiple. If you strip out some of the associates in that, it's probably closer to 30, growing at 30%. It sort of looks not too bad after pulling back a bit. And then you buy Naspers and you're trading at a 42% discount. If they just distributed the whole of Tencent, you'd get 140% value. So it'd be 40% more than the value of Naspers. So it's a deep value situation sitting in there. They need to unlock that at time. We're pretty comfortable on that from a value basis. Another one's in a similar case is Raynet. Who knows what Raynet is? Okay, Raynet holds, it's part of Johan Rupert's businesses, so he owns Rembro and Raynet. He split that out, and then he owns Richemont, which is offshore, all his assets. So he's got Richemont, which is, he says it's his get rich one. Raynet is stay rich. That's how he looks at it, keep it simple. But he hasn't been doing so good in Raynet recently. And Raynet owns British American Tobacco. It's probably 70, well, in the total NAV, it's 70%. It's worth 110% of the actual price of Raynet is what it is. And then you get a thing called Pension Corp, a UK business, very good business. So they will list in the next 2 to 3 years. And so this is trading at a 40% discount to some other parts. So it is extremely cheap. Now we need a catalyst. Now Johan's got very long term, and you don't phase him or move him too easy. But it is cheap as chips. So we prefer that by a long way relative to BAT. And BAT in its own right, we think is very cheap, extremely cheap. It hasn't done well, but recently it looks very cheap. Rayner's the way to go. So that's why we've got that there. RMH also. RMH, we had FirstRand. We switched all our FirstRand into RMH. RMH is sitting at a 14% discount. It's the holding company of FirstRand. It's got a little bit of property in 1%, and the discount has gone the widest it's ever been. So, and we're actually having some discussions with the management around this. They need to do something about this property thing. So we think that's cheap. Okay, then mutual's a big position. We've actually upped it even a bit. So this was the end of March, even a little bit bigger with the unbundling. That's going to effectively happen. They're going to split into insurance company, still holding some Nedbank here, and there's going to be an offshore wealth company. Some of the parts in the unbundling, we think there's about 15% upside relative to some of the parts. So that's also something in there. And then Barclays, as we mentioned, we still think is quite cheap. So that's really some of the bigger holdings. We've got some mid-cap SA. There are a couple of interesting players there. We've been buying Invicta, which is very recently. We've had Udaica for a long time. We own 5% of the company. Another smaller one is Eel Bateman. We probably own sort of 7% of the company, having bought it up in the last 3-4 months. They're the one who just benefited now, one of these players in the Eskom thing, getting the SAPI deal. Trading on a 6 forward multiple to June this year, plus this new contract.
Barry, what do you see as being the catalyst for Naspers getting that active?
Well, we hope when they sold, I mean, when they came out in this announcement when they did the placing of 10 cents, we were hoping they were going to do buybacks. That would have been very positive. Now, they haven't ruled it out now after a bit of pressure, but I think it's further listings of underlyings, and they've got a whole lot of cash they're sitting on. So in the classified space, I think we're going to find some deals that are going to happen. But we were hoping buybacks were going to be quite a big, that would have been a great idea. But they think that with the cash that they've got, the return on capital employed of those ROIs will be well in excess of 20%. So we'll have to wait and see. I don't know. We might need to be quite patient. And when these things happen, they suddenly happen. But they come out of the blue sometimes. Like them suddenly, they'd have pressure, and suddenly they sold 2% of. There was a lot of pressure, and they did that, but they're a bit disappointing because So it looks cheap. So if you're taking a long-term view, you're happy to hold it. It's just how big you have it in the portfolio, because clearly anything more than 10% in a stock in a portfolio is a bit crazy.
No, you're just touching on asset allocation. So your previous slide, you had a bit of a view on the currency fair value at about 1250. Regulation 28 allows you to push the bounds on offshore investments a bit. Is it now a good time to push that 20% to 30%? Increase Africa exposure?
So it is a big change, and it's quite a surprising change, I think, because the currency is so strong. Because for your SA component, you could go 25 to 30, as you say. Africa, you could have had before 5%, that's gone to 10. So if we wanted to, we could take 40% offshore. Now, there's no way in a balanced fund and that we're going to put so much into Africa, a 10% holding. But quite easy, 4/5s, we're quite comfortable with that in a couple of countries, not just one country. But look, where the currency was, I mean, on a PPP basis, depends where you start, and various models, you probably get around 12 today is fair. We think our call's to 12.50 year end. Somewhere around these levels looks pretty reasonable. So we've changed, and for our balance fund, we've now moved where we say our base case is going to be for long term is 28% of that fund will be offshore. Now remember that if of the South African index that you get on the all share index, 60% of the shares in the Aussie by where they make the earnings is actually offshore. It's more than 60%. So you're already getting the Richmonds, the Billitons, BATs all offshore. So if you construct a portfolio, say 30% offshore plus my Aussie component, bonds are obviously all local, you're getting sort of 60-70% offshore. It's pretty high. And I think the problem is if you look out over the next sort of 12 months or so, SA Inc. has got some quite positive tailwinds, which could drive the shares quite a lot. So you've got not much, and I think some of the big institutions are very underweight. I think the smaller managers have shifted. The big institutions are very offshore based. But look, when the currency strengthens like this, it's a good time to make sure you've got a decent amount offshore, for sure. It's far more attractive than where it's.
Laurium, you mentioned your cautious views given the cycle being a bit long in the tooth. How does a manager like yourself or a flexible fund toggle the thinking between staying on the ride and the environment being a bit long in the tooth?
Yeah, we like to think, and we know we will get it wrong. We like to think because we're small, we can move reasonably quickly. We can move quite quickly, so we don't have to position sort of well our fund. I mean, our flexible fund, the flexible fund particularly is running sort of just under 2 billion rand, so we can move that quite quickly with derivatives or what have you. And I think if you look at the composition of stocks in the portfolio, there's quite a lot of deep value sort of in there, sort of more value. We've had a massive growth momentum market globally. Growth has been, for the last 8 years, it's dominated and clubbed value. Obviously, all the tech stocks, etc. So we've shifted, I guess, some of the stocks are sort of those discounts, quite big discounts, which will cushion, we think, or cushion a bit if that happens. But we still think there's decent momentum. So you're seeing companies' earnings, the banks' earnings at the moment, the revisions upwards. So in SA, banks' earnings are being revised upwards quite a bit, probably 5 to 10% for the next 2 years. That momentum's still going up. So yeah, we're running 77% in equity component. If we add in property, we're around 80, low 80s. We've been as high as 95 combined in the fund. So we sort of fairly mid on where we'd look to be in that. And I think on that fund, highly unlikely we would sort of ever go below sort of the 50% equity component on that, I think, because we know we'll get that wrong. Because when markets move, they move pretty quickly. Yeah. So we're cautious, I guess, more on value in the valuation side, and we think we can move if it sort of really looks worrying. Well, when we can't play in the mid-cap space, so the top 40 is really where all the trade is. But then in the mid-cap space, which goes from 40 to 100, by the JSE definition, and then the small cap, which is from 100 more. We still have a few small caps, but I guess at 18 total equity component, I guess if that moves, yeah, I think if we got sort of 30, 35 is quite a big. Yeah, it's quite big. You can't move. A lot of these special situations where you do 500 million, those are big. You can make big differences there. So if you get up to 30, if you're doing 1 billion, it's a 3% position basically, and then it's not going to help as much. But look, there are a lot of guys who have running 5 billion, 500 billion. And do very well over time. But you can't move your portfolios. You can't move around, do things, special things. You just say, this is what I like over time, and you just sit. And they manage to do it decently. But smaller managers, the boutiques, if they've got decent investment teams and a reasonable size, I think can do pretty well. Yeah.
Murray, just thinking around Steinhoff and where the country is in terms of corruptions coming out through our government. We're seeing coming to the fore now, we're seeing the corruption that was in government, which we knew was there, and now that's coming. The Steinhoff is an example of corruption in the private listed sector. What do you see coming? Is going to be more? How do you think about that in terms of special situations? Because when you look at something, you must want to get a feel about the company. Has it, what's changed have you changed your thinking around what happened with Steinhoff, where we are?
Yeah, look, it definitely has brought a far keener focus from everyone out there onto governance. So ESG is a big thing. It's growing bigger and bigger globally, and we have a policy on that, and we have governance is a key part. I mean, the social side, we run some money from Norwegian pension fund, and we've just got 6 different books on how we should approach investing as it happens on human rights, child rights, climate change. The books on everything. So it's a big thing globally what's going on. But we focused very much on governance. So we'll try management, credibility, and yeah. So there's certain management teams that you listen to, you wouldn't believe what they say. They're certainly very conservative. So you have that. Look, and Steinhoff was always aggressive. And we knew that. But then you look at the board, then you put Christo on. Now, Christo's also some not such good stuff coming out with him. There's also a few things. He seems to be getting worse and worse. And then even Investec linked into some of the stuff they were doing. It's sort of, I don't know if you saw today in the papers with Bernard but we focus on it more so than we did. I mean, there are a couple of companies. You look at EOH, you look at anywhere there's a bit of a worry. The discount rate that you're applying to stocks has gone up, basically, for the market as a whole, 100%. You can see it in Capitec now. You can see it in EOH. The guys won't go near this thing. There's some noise there. So I think we just try and be more due diligence on that. We've always been aware, but you just heightened awareness of that. But if you think there's a bit of a risk, hang on, well, maybe don't even go. Maybe you shouldn't even go if there's the slightest doubt. You just, the levels of company have been pushed up, I think, across the whole market. But it's not good for SA, because I think if you look at the ease of doing business, South Africa's rating in the financial market, we've just slipped massively now in the IMF. That's all world competitiveness and that. All our auditing professions, market governance in the JSE, we were top 3. We've now moved significantly outwards, which is not good for SA Inc. And then government also now have a scapegoat to say, oh, well, look, it's happening all over, which is unfortunate.
Other questions?
Yeah.
So just to follow up on Greg's question, obviously everyone is this heightened awareness around specifically governance, like you mentioned. I mean, does that potentially create an opportunity for a business like yours, specifically in the hedge fund space? And what I'm sort of getting to is, I mean, like a business like Resilient, I mean, I think noise has created a lot of price movement.
Yeah, look, I think that's absolutely right. As soon as there's concerns around companies, people they get nervous. So the vol from that is much higher than what it was before. So, and the Resilient, yeah, look, there's been some papers come out, Resilient. There's a lot of, I mean, we'll just have to see what comes out. Under investigation, there are a whole lot of things that are there. We'll see what comes out there. I mean, we've done a lot of work on it, and the report was surprising what came out. The independent report, that the board's independent report. Cool.
Hasn't been published yet.
No, they came out.
It came out, but
With the finding, they found nothing wrong.
Yeah, they found nothing, but nobody's seen it yet. It's still with the FSB and with government.
No, there was an announcement saying independent review on all aspects in the scope. They found nothing.
Yeah, but no, you haven't seen the actual report. That's
No, that went back to the company, and this is what they released. There's nothing. The FSB and the JSE are still investigating, and we'll wait and see what comes out. We're very surprised on what has come out. And we've done a lot of work on different things that we thought were happening.
Yeah, 3, 1,
Yeah.
2, 3.
You showed us that you still projected we could make 2.5% in terms of growth this year. In spite of all the corruption that is, I don't think we've seen it's just my personal view, but I don't think we've seen the tip of the iceberg yet. That's number one. And number two, the whole land issue. Personally, I don't watch carte blanche too often because it upsets me. But I did last week, and traditionally, as usual, got upset with that. I don't know if you saw it, with that insert about there is a chief in KwaZulu-Natal
Dishing out land.
who is dishing out land, making a fortune of his own people. He's not dishing it out; he's selling it.
Yeah.
And he's actually selling farms that belong to people. And his attitude to title deeds is, my great-grandfather didn't have title deeds, and the land is ours.
Yeah.
Do you think we can still make 2.5% growth in spite of all of
Look,
this?
irrespective, look, I think South Africa is about confidence, and I think confidence has changed significantly. The land issue, obviously, is a big thing. Cyril's come out and said he needs to appease the masses, but he's come out with some caveats. I think it still needs the constitution, so they're going to come back with the report to Parliament now. Government owns huge tracts of land still that they could dish out. It is a big issue. It's a motive issue. Cyril, I think, is very well. So he's going to be a bit of a balancing act, I think. And I think it's going to be reasonably pragmatic. They've seen what's happened in Zim. there will be, without a doubt, I'm sure there will be some without compensation, but I think a lot of it could be done through government. I think we're very lucky to have Cyril in there. Slowly, he's been on all the boards, he's been around, he's okay, he doesn't have his full cabinet in, but he's quite good, and I think as you move forward in time, he will, one or two guys will shift by the wayside, but have been very corrupt. So I agree with you, there's tons of corruption still to come out, but confidence in the stock turn alone could add one. We think the stock turn could add, just from restocking up, could add 1% alone to GDP this year. Because people were very negative. So confidence changes, and then your fixed investment spend comes really into next year. So I think I think 2.5 to 3 is quite comfortable this year. Well, we think. Unless there's something really fall down. Globally, things are growing, so it looks very good for now. But longer term, they're big structural forces, the unemployment, healthcare, how we fund things. But for now, I think it's quite a positive environment. So maybe it is a time, cash, when things are positive, really positive, it's a time to balance your portfolios that you just take a little bit more.
Sure. Question at the back.
No, I don't think. I mean, South Africa is very ring fenced. In fact, we had a meeting with the Reserve Bank because there was about 60 billion of assets in South Africa, and there was debts of probably 25 billion, and that's sort of ring fenced. And so the SARB needs to get the money to go offshore. So they're cleaning up the debt locally and paying everyone back out. There's some interesting press that sit in there. And there's no issue on the local side on that front. SARB is very much in line, banks, etc. They're all over that. The shortfall is sitting in Europe, huge shortfall. So the money needs to be released from here. So, but first you need to pay all the debts off, and then money will be released up. But coming back to PSG, I don't think there's any issue at all. And PSG is a standalone entity, 25%, and it's gone down to zero. So I don't think at all there's any issue on it. The stock now is trading in the sum of the parts, it's about a 10% discount, 10-12%. The results are actually out, I think, for stable in the next week. So you'll see Consult come out, you'll see Puro come out, Capitec, and then obviously you're going to have the PSG presentation. So there's going to be a lot of commentary, I guess, in the papers around the stable in the next 10 days. But I don't think there's any issue on pricing play. Nothing. I mean, the guys from all dealings for those guys, 100% honest guys.
I know PSG quite well, and PSG did hold Steinhoff and have in the past, but was sold out a little further back than I don't know the exact date. And then Jan Mouton, who was obviously involved for a long time, actually stepped away 2 years ago.
Yeah.
So it's actually not that recent. So he'd already moved out of the investment team. And PSG Asset Management and PSG Group are quite different. They actually got quite a bit different culture. They don't sit in, one sits in Stellenbosch, one sits in Constantia. So they're not really that close. They're obviously owned, but it's quite a separation there. So we obviously looked at that because we do invest in PSG Flexible.
Which is done obviously extremely well over time. Yeah. It's owned by Consult. So Consult is the holding company. First is the CEO of that business, and then Annette Hearn, you know them both pretty well, who runs the asset management, CIO or CEO of asset management, and then the funds fall under that. Yeah. But I don't think there's anything at all.
One question. Yeah. Last question.
Sorry, last question. I think it's been answered. Is this on this your opinion about actually domestic growth and Ramaphosa's investment forum or whatever he wants to create now in August to try and generate 1.2 trillion into South Africa? And I was just trying to get what the impact of the land issue be on such a, is that an asset test in terms of how serious the world outside of the local investors would take it? Is your feel on that?
Look, I think that this whole government and business initiative, which got started by a couple of guys really driving that. Clearly fell apart. Zuma wasn't there. Everyone else was trying to get Praveen and them trying to get things going, and that fell apart. That whole thing has come right back together. So Cyril is, and Stephen Costa's very involved, and Gore, a couple of others. That initiative is very much together, and companies have committed to taking people who didn't have jobs to 1 million, and they've literally said this company will take so many on an Excel sheet, so many people to this company. So I think that's great. The business and government initiative with Cyril there is back in place, and government and private enterprise working with government, I think, can do huge. If we start, obviously our parastatals, Eskom's a huge issue. If we suddenly get private-public partnerships start to happen, longer term, also going forward, that could be huge. Now, we need to see what happens. But if that starts happening on Eskom, they do some stuff, I think our growth, we could be very surprised on the up. Us South Africans are pretty negative normally. Internationals get more bullish. So there's a lot of quick wins. I think the corruption stamping that out that can be done, and business working together with Cyril, I think it's going to make a very big difference what we can do in the short term, definitely. So from a very low base, we can get up quite quickly, I think, as long as the world doesn't fall over in the next 2 years. The growth still looks okay. Thereafter, I think that's when it's really going to be very difficult for structural impediments to get those right. We'll have to have very bold moves that get made, and that's going to be, I still think, a very big challenge. But next 2 years, I think there's some big uptick from where we were. Off a very low base, we'll go up. And we generally, when things start going up, you get surprised on the up. When things goes down, you get surprised on the down. That's what always happens. Well, 90%, 80%, 90% of the time, that's what generally happens. So, cool.
Great. Thank you.
Great.
Thanks very much, Murray.